Well, good morning to everybody, and welcome to the October Revenue and Economic Update. For today's presentation, we're going to provide an overview of the economic forecast for calendar year 2020 and 2021, and we're also going to provide an update of general fund revenues for fiscal year 2021. I believe the presentation will run about 30 minutes, and I'll attempt to address the questions at the end. And please use the chat feature in Zoom if you have any questions that you would like to submit. Finally, I'll note that the presentation and the report should be posted to our website by the end of this presentation. If you do not see it there at the end, it should be posted shortly thereafter. And with that, I will begin the presentation, and I would like to start off with the economic forecast that we used for our official revenue estimate back in June, and then our latest forecast for October 2020 that will motivate the revenues that we will present today. And I'm just going to focus on the current year and the next year for 2020 and 2021. And you'll see that our forecast for October 2020 is a little better than what we had assumed 4 months ago. So for real gross domestic product, we have economic output contracting by about 4.6%, wages and salaries paid falling by about 2%, the average job gains or losses in this case falling by about 450,000, and I'll note that that's an average for the year, and then the consumer price index at about 1%. And so you can see that overall, the economic forecast for 2020 is a little better than we had assumed 4 months ago. For 2021, we have the opposite. We have pulled our forecast down, and we have real GDP at 3%, wages and salaries at 3.7%, job gains at 100,000, and the consumer price index at 1.5%. And I'll draw attention to the job gains. You'll note that last June, we had assumed 310,000 jobs would be recouped in 2021, and we have pulled that down to 100,000 jobs, and I'll touch more on that later in the presentation. One of the big stories, as you're probably all aware, is the large federal stimulus and the monies that have been injected into the state economy. And what we've done is we've compared those injections into the state economy to the lost labor income. And at the top part of the slide for 2020, we have our estimates of the labor income that was lost for the entire year. And there's more detail in the report on how we derive these estimates, so I'll just give you the highlights. The IFO believes that for 2020, in wage and salary income, we lost about $21 billion due to the pandemic. For self-employment income, we lost about $3.2 billion, and in temp income, we lost about $1.5 billion, for a total of lost labor income of about $25.5 billion for the year. Down below, we have the monies that were injected into the state or state unemployment compensation monies. And so for regular state UC, we had $5.2 billion. For FPUC or federal pandemic, the $600 a week, $15.9 billion. Other federal assistance at $10.2 billion, and the major programs are here to the right. And then finally, the economic impact payments at $11 billion for a total of $42.3 billion. So our estimate is that the monies injected into the state economy from these programs did exceed the labor income that was lost. And the economic impact payments, of course, are going to many people, not just those who lost their jobs. We think it went to 6.6 million Pennsylvania residents. But even if we were to remove the economic impact payments, the monies injected into the state economy would still exceed the lost labor income by about $6 billion. And so this is a major part of our story, and one of the reasons why our revenues are holding up so well, and one of the reasons why we're adding monies to our revenue estimate for this fiscal year. On the next slide, we just take the information from that table and we slice it up into 3 quarters for 2020. And for the first quarter, for quarter 2, you can see that we estimate lost labor income of about $11.7 billion. but then we have injections of about 24.3 billion into the state economy for a net impact of 12.6 billion in the second quarter. For quarter three, all of these series come down and the net impact is about 7 billion. And then finally for quarter four, we think the net impact is a negative $2.8 billion. And we believe that we have not yet started to see the impact of the negative, the reversal. And we do think we'll start to see that in our November revenues, in particular sales tax revenues. I'd like to say a few words about the PUA, or the Pandemic Unemployment Assistance Program. The reason for that is this program is much, much larger than we had assumed back in June. And this is one of the reasons why we think our sales tax revenues are outperforming our original projections 4 months ago. So just as some background, the PUA program runs from January 27th of this year, so you can make back claims, to the end of the year. It only uses federal dollars, and the average weekly amount is about $200 to $230 per week. The benefits are paid to self-employed, gig workers, and others who are normally ineligible, such as students or part-time workers that have an insufficient work history. And as I noted, the payouts from this program are much, much higher than we had anticipated, and we are currently estimating them at $7 billion through the end of the year. Now, if you look at the underlying claims data from the Department of Labor and Industry, what you'll see is that the average weekly PUA claims are running from about 750,000 to about 850,000 in the third quarter. And what's unusual about this is that if we look to the Social Security Administration and we look at data for the total number of self-employed in Pennsylvania that are paying self-employment taxes, the total number of individuals is about 750,000. So these data would suggest that every single self-employed individual is receiving PUA. However, there are other individuals that could receive PUA, such as individuals who had jobs before and weren't just self-employed. They may have been students, or they may have insufficient work histories. And for that, if we look at the regular state unemployment compensation claims, we find that they're running at about 620,000 in the third quarter. And we also know that year over year, we now have 505,000 fewer jobs. And we know that normally in the third quarter, about 110,000 claims are paid. And so that these two figures, the 505 and the 110, they roughly line up with the 620 in regular state UC claims. And so we do think that all of the part and full-time job losses appear to be accounted for. And then the question arises is that who is receiving the PUA payments? And we're not quite sure. We can't reconcile these numbers that we're showing you here, but this extra monies that are being injected into the state economy do appear to be driving at least a portion of the strength in our sales and use tax collections. And I'll note at the very bottom here that many states have reported serious issues with identity and other fraud that are related to this program. Turning to the job market and how things are holding up, here we have some data from the Bureau of Labor Statistics, and we've taken 3 snapshots. One was the peak job loss that occurred in April, and these are in thousands. So in April, we had about 1.06 job losses compared to the prior year. And then you can see in July, it recouped, it recovered, and we had 539,000. And then in September, a little better, but clearly the pace of improvement is decelerating at 477,000 jobs. Over here, you have the growth rates year over year. So for September, we lost about 8% of our jobs relative to the prior year. And there's a lot of numbers on the slide. I won't run through all of them. I'll just call out a few highlights here for the numbers that are in red. Retail and wholesale trade, we lost about 62,000 jobs. Education, you can see it's down 36,000, and note the pattern here. With the start of the school year, the job loss picked up, and I'll note that the data you have in this table are not seasonally adjusted, so that is driving that result. Accommodation and food service, by far the largest, 128,000 jobs, most of those in full service restaurants. And then finally, other services at 33,000 jobs. And this would include barbers, hairdressers, nail salons, dry cleaners, maintenance shops at a 13% loss. On the next slide, we take a look at the latest economic data we have for the state to get a picture of how the state economy is performing. And in the first column, we have the growth rate for 2019, and then we have the growth rates for the 3 quarters that we have some data for. And I'll just run top to bottom. So for real gross domestic product, we have a contraction in the second quarter of about 34%. I'll note that those data are very preliminary and they could move a lot going forward. Personal income, you'll see we actually have a gain in the second quarter of 12%. And that is due to the large federal transfers that took place. Wages and salaries, we think they fell by about 6.5% in the second quarter and 2.5% in the third quarter on a year-over-year basis. And then here we have some weak inflation as measured by the Philadelphia Consumer Price Index. Down at the bottom half of the slide, we have a snapshot of the Pennsylvania labor market. And on average for the third quarter, the unemployment rate was 10.4%. And again, I'll note that's not seasonally adjusted and it excludes discouraged workers. On a year-over-year basis, on average, we lost about 506,000 payroll jobs. And the labor force also shrunk by 156,000. And so one of the reasons we have an improving unemployment picture is not only because we're recouping payroll jobs, but also that individuals are leaving the labor force. And a few weeks back, the Wall Street Journal had an article on this and noted that women were leaving the labor force at 4 times the rate of men. So this is certainly a long-term concern for the state economy and for output. A couple of other factors that are bolstering spending that we're paying attention to. The first one is that applications for refinancings grew by 200% in March to May. And of course, the refinancings can be used to reduce your monthly payments or to take out equity in your home. The latest data that we're seeing here shows a clear deceleration in refinancings. In September, the applications were up 80% year over year. So we do think this factor has largely played itself out and is baked into the economic growth that we're seeing. Another factor, you probably know that the CARES Act allowed for early withdrawals from the 401ks and IRAs. This could be up to $100,000 for qualified persons, and the 10% penalty does not apply in this case. Any associated taxes can be paid off ratably over 3 years. Unfortunately, we do not know at this time how many individuals had taken advantage of this program, but we do think that it is providing support to consumer spending. And finally, the last factor, of course, there has been shifting consumer spending patterns. There has been less out-of-state travel, and we do know that gasoline consumption in the state is down by about 10%. And so both of these factors implies that there's less leakage from the state economy and the monies are retained in Pennsylvania. And then, of course, we also have different spending patterns, more on home improvement, cars and appliances and computers. And of course, all of these items are taxable and provide a boost to our sales tax collections. I'd like to turn now to a look at our revenues since the start of the year. And in this slide, I've looked at 2 periods. One is a mitigation period. It is the 4-month period from March to June. And the second period is the 4-month recovery period from July to October. And the numbers you see here, we would call them base growth rates. They control for all the shifting that was occurring and the one-time transfers and other tax relief. And if you look at the mitigation period, you can see the drop-off year over year in the revenues. For all general fund revenues, a drop-off of 9.2%. And then we had very large drop-offs for motor vehicle collections because dealers were closed, and for cigarette tax collections due to processing issues, and finally for realty transfer tax because homes could not be shown. For the recovery period, the latest 4 months, we have an increase year over year in general fund tax revenues of 4.4%. And in particular, we have some surprising strength here in sales tax for both non-motor and motor vehicle. Withholding is even holding up well, 2.4% reduction year over year. And then finally down here for cigarettes, we think there are some processing issues and also the impact from COVID that more people are now, of course, working at home, which may lend itself more to cigarette consumption. So turning to our revenue estimate for this year, just as a reminder of where we are relative to the administration. Last June, our official revenue estimate was $35.87 billion. The administration issued a revenue estimate last May of $34.6 billion, and the differential between the two is $1.24 billion. And our revenue estimate was generally above the administration in nearly every category, with the exception being personal income tax, non-withholding, where we were lower by about $140 million. So to that estimate, we are going to add $650 million based on the strength that we're seeing for the first 4 months of the fiscal year and a somewhat better economic picture for the current year, although as I noted, the outlook for next year has been pulled down. And so the $650 million, the main place it's being added is to corporate net income, $120 million. We're adding $400 million to non-motor sales tax and $90 million to motor vehicle sales tax. And some here down to cigarettes at $40 million. Here in this column, we have the dollar shifts. These were monies that were shifted out of last fiscal year into this fiscal year for tax relief. If we remove these dollar shifts from the current fiscal year and we make some other adjustments for one-time transfers, we have the adjusted year-over-year growth rates for the revenue sources in the final column. And you can see that overall general fund monies, once we make these adjustments, up by 0.2%, corporate net income down by 8.4%, and then here are the gains in sales taxes that are running stronger than we had expected. Just want to say a few words on non-motor sales tax because it is running much stronger than expected, and there were a number of federal programs that were providing support to this revenue source. And I'll just walk you through the last 10 months and to review those programs as they phased in and phased out. But you might recall back in January through March, non-motor vehicle sales collections were running strong. They were running by about 6 to 8% year over year gains, which for this revenue source are very solid gains. And then the pandemic hit and we had business closures. The economic impact payments went out in April. And then shortly thereafter, sales tax revenue started to recover and some other federal programs began to phase in particular the FPUC, the $600 a week, the PUA to gig workers, and the PPP or Paycheck Protection Program in the months of May, June, and July. In June, we also had businesses start to reopen. And more recently, a few federal programs ended, the FPUC, and then finally the LWA, which is the lost wage assistance. This is the $300 per week, has ended now as well. But that program contributed to what we observed in October, and we think non-motor sales tax was about $936 million, which is a growth rate of 4.3% on a year-over-year basis. And I'll note that there are still some federal programs that are running through the end of the year, in particular the PUA and some extended benefit programs. But slowly these programs are phasing out and less support is being provided. And the question, of course, is can this growth in sales tax maintain without these supports? So we'll be keeping a close eye on that. And we do think that in November, we'll start to see some of that impact. So a few factors that motivate the upward revision to our revenue estimate. As I noted, sales tax is running much stronger than we had expected, and there are various reasons for that that are listed on the slide. that we've already covered. I'll note that motor vehicle sales tax are also running stronger than we expected. And it does appear that all of the lost car sales that occurred in April and May because the dealerships were closed, we do think we have largely recouped them. Corporate profits are also running stronger than we had anticipated. And in fact, the latest national projections, many forecasters are assuming that there's no reduction in corporate profits for the current year. But if you look at the underlying detail, there's a wide disparity in results. So high-tech firms and grocers are doing very well, but energy firms are not. And what's happening here, we think, is that there's productivity gains for workers, there's some cost cutting going on, and of course the elimination of travel expenses. All of these factors are flowing to the bottom line and providing support for corporate profits. And finally, the last of the big three, personal income taxes are outperforming expectations. It's pretty moderate. They're largely where we thought they would be. The wage forecast, as you saw, is slightly stronger than we had assumed. And we also think that small business income and capital gains are outperforming, but this is harder to quantify. And certainly the activity in the stock market over the last 3 or 4 days gives some concern as well. So there are two other factors that I'd like to note that are unclear and we have not explicitly built into our forecast. And just to provide you some background on that. The first factor is the national renter eviction ban, which ends at the end of this year. And how big an impact will that have? And that is difficult to pin down because there's many different estimates out there and it's unclear which one is more or less accurate. And I'll just give you two of the estimates here so you have a sense of that. One estimate is by the US Census Bureau, which puts out this new experimental pulse survey. And in that survey, they find that nearly 19% of PA renter households missed their last rental payment. And if that's the case, it would impact about 300,000 renter households in the state. More recently, in fact, I think just in the past week, the Philadelphia Fed put out a report that found that 4.5% of PA renter households would have rental debt by the end of December. And that's based on more established data, the IPUMS data and the CPS. And if that's true, then it would affect 48,000 renter households who would have 224 million in rental debt for an average of 4,700. So right now, we have no doubt this is an issue. It should be a concern, but we're having difficulty pinning down exactly how large it is until we have some more data on it. The second item I note is the status of the PPP or Paycheck Protection Program and the loans. We do think all of those loans will largely be forgiven. Back in April, the IRS had made a determination that those loans would be taxable, but that does not appear to be the intent of Congress. And whether or not these loans are or are not taxable has significant implications for our tax revenues. Total US loans going out to all businesses was $525 billion, and that would affect our corporate net income tax base because that would be, the profits are apportioned to the state. And for the personal income tax, we know that 21 billion in loans were made to PA businesses, and perhaps half of those are going to a flow-through entity that would be subject to the personal income tax base. For the purpose of this estimate, we have assumed that they will be non-taxable. However, if it turns out that they are taxable, again, it would have significant implication for our revenue forecast. I'd like to close up the presentation by noting a few factors that could transform the Pennsylvania economy and how the pandemic affects our long-term output. And we do think there are significant implications, in particular for long-term employment and long-term jobs. And I'll just walk you through our rationale on this slide. As we covered, we think for calendar year 2020, that on average, there will be about 450,000 fewer jobs. And as I covered earlier, we think that is about 25 billion less in labor income. And of course, that directly translates into lower spending, and the great majority of that would be spent in the state. However, we could look at various factors that suggest that that lost spending and the output, or GDP, will be replaced in some fashion. And I'll give you a few examples on this slide. One, as we discussed, we know that gasoline consumption has been reduced, we think, by about 10%, and that translates into about $1.5 billion in spending. So of course, those monies used to flow out of the state, and now they would be redirected in the state, and those monies, that spending is not necessarily lost, it's just redirected to a different purpose. We also think there could be some net gains from less personal out-of-state travel or less leakages. So while it's true that individuals come into the state to vacation, on net, we think more leave the state, and the spending flowing out of the state economy exceeds the amount flowing into the state economy. So we think there's likely some net gains there. And finally, there are productivity gains for workers. And just to give you a sense of the magnitude of this, if workers are 1% more productive, that implies that state GDP would go up by $7 billion. So it doesn't take much gains in worker productivity in order to increase economic output. And let me note that productivity, there can be good productivity gains and less good productivity gains. So on the good side, you would have things like automation that are making workers more efficient, and hopefully that translates into wage gains. However, you could also have a situation where workers are asked to do more, but don't get paid any additional amounts. And so that could also increase productivity. But regardless of what's driving it, it has the same result. It can replace the output that was lost from folks that no longer have employment. So we do think these factors, the productivity, the cost savings to businesses, and the redirected spend, we do think there's potential that it could fill much of the gap from these jobs that were lost. And then the question is, what happens to the jobs that were lost and the individuals who held those jobs? And there's also the further question of the composition of income. Are we just having a different composition of the prior level in income in a different form? And that is, it could just appear to be more profits or self-employment income or pass-through profits as opposed to wage income. And then one could extend that further to ask questions about income distribution and income equity. So we do think that there's all these factors in play, and we do think there's some long-term issues that policymakers should pay attention to, and hopefully they are able to do so after the election. So looking forward, just a few things to note. I would note that our projections do not assume any new major federal stimulus or business closures. It's likely that some federal stimulus would occur, but we're just not sure of the form and timing. And we thought it best right now to just leave that out of our revenue projection. It's also possible there could be additional business closures due to the recent surge in cases, but we haven't assumed that. As we discussed, we are anticipating a drop-off in consumer spending that has yet to occur. Many of the federal programs are starting to phase out. In particular, the FPUC and the LWA programs are now finished. And going forward, the PUA and the extended benefits will also expire at the end of the year. And finally, as I noted, we just draw attention to this long-term unemployment issue, and we do think it is a major concern because we do not think that many of these former jobs will return, in particular in the food service, accommodation, and travel sectors. Businesses are undergoing a major transformation right now in terms of teleworking and automation. And as I noted, what happens in these times is usually workers do become more productive, both due to automation, but also because they're asked to do more. And that translates into fewer employment opportunities overall. And with that, I will conclude. As I noted, hopefully the presentation and the report are now posted to our website. If they are not, they should be posted there shortly. And at this time, I will attempt to open the chat feature in order to see if we have any questions that I can address. Okay, very good. Well, I am not at the moment seeing any questions on the chat feature. So let me say, if you do have questions after the presentation later today, please feel free to submit it to the IFO contact box, and we will be monitoring that, and we'll try to get an answer to you as soon as we can. Thank you, and have a good day.